Hi, this is David of Bionic Turtle. Welcome to video 6b, which is the second video of 4 in the credit risk topic, which is a part 2 topic for the 2012 FRM. And we continue in sequence of the study guide. Canabero reappears as an author for the second time in credit risk. However, the reading is new, and I highly recommend the source reading. I think Art made an excellent choice because until this reading, the credit risk topic did not have a very good introduction to CVA, the credit valuation adjustment. And this is, in my opinion, an excellent introduction to CVA. So we'll take a look at that. Christopher Culp, 4 chapters on credit derivatives that have been for several years in the curriculum. They survived the financial crisis owing to their theoretical and academic nature. So we'll take a look at those as well. 2 learning spreadsheets. At the time I'm publishing this, I don't quite have up yet the credit value adjustment. It will be up. I would be very grateful if you wouldn't post on the forum about why it's not up there. I'm going to be putting it up after I publish the video, but it will show up eventually. So the CVA spreadsheet that will illustrate the CVA concepts that we're gonna look at. So I'm gonna really try to annotate that and make that useful to you. And then 6b2 excess spread illustrates concept coming up in Culp. So in terms of the Canabero reading, pricing and hedging counterparty risk. So first, just some definitions. Counterparty credit risk is the risk that the counterparty may default before the transaction is settled. So please notice that counterparty risk is a type or subclass of credit risk. The authors note there have been enormous progress, but banks continue to lose billions of dollars due to counterparty risk. The credit value adjustment, CVA, is an adjustment made to the credit risk-free value of a derivative contract or a portfolio to take into account the market value of credit risk faced by both of the counterparties. CVA is the credit risk premium of the derivative contract of the portfolio. So you'll notice it's an adjustment we're going to make to a value that is credit risk free. If we think about, for example, the pricing of an interest rate swap or this credit default swap in John Hull, the way that we do that there is we're really implicitly assuming both of the counterparties are going to deliver. So that really is computing a credit risk-free value. CVA would then come in and make an adjustment to that value based on the respective counterparty's credit risk. If Bank A faces more credit risk than counterparty B, its CVA will be negative. After all, if you're Bank A, and you're facing more of the counterparty credit risk, you want to subtract from the price you're willing to pay for that position. On the other hand, if you face less credit risk, you should be willing to pay more, so the CVA will be positive. So in the notation here,